MIRAI Corporation. Financial Report for the Third Fiscal Period and Progress in the Midterm Management Plan. Section 1. Summary of Financial Results. DPU declared for the third fiscal period increased by 59% from the second fiscal period to 5,175 yen. This was mainly due to the extension of the operation period to a normalized level of 184 days. Leasing revenue remained generally as expected. Utilities revenue came in below expectation, which was offset by the lower repair and maintenance expenses. Actual DPU in the third fiscal period was 75 yen above the forecast announced earlier. The occupancy rate of our portfolio in the third fiscal period was higher than expected, topping 99% each month. The contracted rent per tsubo also remained generally flat, which helped achieve stable cash flow. In the fourth fiscal period, we expect DPU will reach 5,600 yen, 8% above the third fiscal period. This is backed by the significant contribution of gain on sales of Shinagawa Seaside Park Tower and the leasing revenue of Tokyo Front Terrace. For the fifth fiscal period forecast we are announcing for the first time, we expect DPU to remain stable from the fourth fiscal period at 5,600 yen. The main driver will be the opening of Nara Heijo Plaza in the spring of 2018, which will bolster the profitability of our portfolio. As a result, stabilized DPU will increase by 10% from the level forecast at the second fiscal period result announcement. We will continue to manage our portfolio while ensuring sustainable growth of DPU. The price of investment units of MIRAI Corporation has been recovering since April 2017 and outperformed the Tokyo Stock Exchange REIT Index. We will build a stable track record while setting the recovery of the investment unit price on a par with NAV per unit as a near-term target. Section 2. Topics in the third fiscal period. 1. Risk diversification through asset replacement. MIRAI Corporation has decided to sell a part of its interests in Shinagawa Seaside Park Tower, the largest portfolio asset, to significantly reduce the concentration risk in the fourth fiscal period. With the proceeds, we will acquire Tokyo Front Terrace and Nippo Honmachi Building to enhance asset and tenant diversification. When the asset replacement is completed at the end of February 2018, the number of properties and the number of tenants in particular will increase significantly, and the investment ratio in the three largest assets will decline from 65% to 51%. The concentration risk, which has been a concern for us, will be reduced substantially. To steadily implement such strategic asset replacement, we are receiving full support from both of our sponsors, namely Mitsui & Company and Idera Capital Management Limited, in our financing and deal sourcing. Tokyo Front Terrace is a large office building which was completely renewed in 2015. The entrance and office have become a sophisticated space, and through exhaustive renovation, air conditioning systems were overhauled and LED lighting was introduced throughout. Leasing began in the second half of 2015, and the occupancy rate has risen to 96.5%, as the renovation was highly appreciated. The tenants are engaged in a wide range of businesses, centering on information and communications, as well as service sectors. Even the largest tenant occupies less than 20% of the space, suggesting that a diversified tenant base has been achieved. More than 80% of the tenants started the contract in or after the second half of 2016. Given the fact that many have just recently moved in and that the tenant base is well diversified, a large vacancy risk is considered to be low for now. Contracted rent per tsubo is mostly from the mid-16,000 yen range to the low 17,000 yen range. The weighted average rent per tsubo is 17,000 yen, a level close to the prevailing market rent. The rent level is reasonable in comparison with the three central wards of Tokyo, where large supply continues, as well as the central part of Shinagawa Ward. Because of the good balance between convenience of location and building specifications, solid demand is expected to continue from those tenants who are highly cost-conscious. 2. Acquisition of growth asset to improve profitability. As a growth asset aiming for higher profitability, we have acquired MIRAI Plaza, which is slated for renovation and reopening in spring 2018. Through one-on-one negotiations with the seller from the early stage, we were able to acquire the asset at relatively advantageous pricing. The contract sign-up ratio is about 80% of the total rentable area, including preliminary agreements. Amusement facilities make up more than 30% of the entire area, as suggested by the name tourism-oriented retail facility. This is followed by lifestyle, fashion, and kids stores that enrich the lives of local residents. Long-term contracts of more than 10 years account for the majority, and fixed lease contracts are concluded with most tenants, with a few exceptions such as public agencies. This has increased the stability of the leasing management. Fixed rent or a combination of fixed and sales-linked rent with a minimum guarantee make up about 60% of the contracts. On the ground floor, the main tenants are grocery and drugstores, and it features a large food court with about 500 seating. A popular pet shop has been invited to increase customer traffic. On the second floor, the tenants are mainly fashion and household stores, and Heijo Shopping Street, which brings together local stores, adds charm. The third floor targets families with toys and kids stores. A nursery for employees will also be provided to support diverse lifestyles. The fourth floor offers entertainment and tourist attractions, with a samurai and ninja museum and a goldfish museum which are popular among foreign tourists. It also offers space for fairs and events. The fifth floor and rooftop will feature one of the largest amusement facilities in Nara Prefecture. Also on the rooftop, there will be a beer garden to enjoy barbecues and shows, providing a place to relax on weekends and while sightseeing. On the seventh floor, which used to be an observation deck restaurant, an accommodation facility offering a scenic view of the Heijo Palace site will be set up to meet tourist demand. As described, Nara Heijo Plaza has a diverse tenant base, with amusement facilities and a supermarket as core tenants. We are currently in negotiations with potential tenants for the remaining 20% floor area. As small tenants are the majority of these potential tenants, further diversification will be achieved if leasing progresses as expected. 3. Further strengthening of financial base. We have obtained new loans totaling 20 billion yen to acquire properties and refinance short-term loans during the third fiscal period. Of the new loans, a 10 billion yen short-term loan will be repaid in February 2018, with the proceeds from the disposition of an asset. We have also established a new commitment line of 2 billion yen to secure the flexibility of our financing. As a result, after the repayment of the short-term loan, all borrowings will be long-term loans with a fixed interest rate. The average remaining maturity of loans will be extended to 6.7 years, and our financial stability will be further strengthened. MIRAI Corporation has obtained a credit rating of A+ from Japan Credit Rating Agency. MIRAI Corporation is strengthening IR activities targeting individual retail investors and communicating information through participation in various events and briefing sessions. A new initiative has been introduced to distribute videos on our website and YouTube channel to explain the details of our results announcements and asset acquisitions. We hope this will help MIRAI become a more easily understood and accessible investment corporation. 4. Progress in the Midterm Management Plan. MIRAI Corporation has developed the Midterm Management Plan Repower 2020, setting 2020 as the final year for achieving its targets. We plan to raise DPU to 5,700 yen or above by striving to increase the profitability of the portfolio, while enhancing risk diversification at the same time. The midterm management plan is making steady progress thanks to the asset replacement and the acquisition of a growth asset. DPU for the fourth and fifth fiscal periods is expected to achieve a progress ratio of 98% against the 5,700 yen DPU target. Summary: DPU declared in the third fiscal period is 5,175 yen. DPU for both the fourth and fifth fiscal periods is expected to increase to 5,600 yen. The occupancy rate of the portfolio is expected to remain above 99%, maintaining almost full occupancy. In terms of financing, we will further improve the long-term fixed interest debt ratio. The quality of cash flow has improved, with property and tenant diversification making significant progress. NAV per unit has risen to 193,000 yen as a result of an improvement in the portfolio profitability due to the acquisition of a growth asset. Finally, please note that these explanations are not intended to solicit the purchase of the investment units of MIRAI Corporation or the signing of other financial product transaction contracts.